Hello and welcome back to the course. In this lecture, I will explain to you how to make financial statements out of all those ledgers that we had filled out in the previous lecture.
There are three main components of any financial report. First of all, it is the income statement, which is also called profit and loss statement or just P&L. Then there is the balance sheet and the statement of cash flows, which is also called cash flow statement. Here we see the ledger with all our operations for our small business for the first year of its operations. Here is some magic. If you recorded all these accounting operations correctly, then making financial statements is a very straightforward task. So here is the balance sheet, here is the income statement, and here is the statement of cash flows. Just like magic. Quite simple and straightforward, and let us look at these three reports in a little more detail. The first financial report that we're going to explore a little bit is the income statement. Here is the income statement on the left in a sort of a more structured form that is usually used for income statements. It shows you the profit that the company had for the year, or a loss if the company had a loss. Any income statement begins with sales. Sales in our case is our revenues for the period, 240K. Then there's the cost of sales. Cost of sales is usually the variable cost. Let me explain to you what variable cost is. For example, you have a unit of inventory that you bought for $50 and you sold it for $200. So you sold one unit. You got $200 from the customer and you paid $50 to your supplier. You sell the next unit. You also get $200 from the customer and $50 you have to pay to your supplier. Your personnel cost, in this case, does not necessarily change with every unit that you sold. Your employees at the warehouse, they have fixed salaries, so you do not have to pay them based on the number of units that you sell. That is why variable cost is a cost that changes with every unit sold. If we take the revenue and then deduct the cost of sales from this revenue, we get to gross profit. Then, after the gross profit, we have other operating costs, which are often called OPEX, operational expenditures. And these are usually the fixed costs that we have just talked about. As you can see, in the end, our small business had a net profit of $30,000. Of course, there are certain taxes, but for the purposes of this case, we believe that there are no taxes. For example, we've got some tax deduction for small businesses and we don't have to pay taxes for the first 3 years of our operations, for example. What I want you to understand is that the income statement gives you sort of a theoretical profit. It is based on a lot of assumptions. For example, even for our small business, when we made this income statement for it, we used an assumption. The assumption that all 40K that has not been paid yet will be collected eventually. Suppose this will not be the case. Suppose someone who owes us 30 grand does not pay for some reason and will not pay in the foreseeable future. Then what happens? We'll have to write down the whole debt, and our profit for this year could turn into a loss. Further in the course, we will learn how to deal with these risks of the business. For now, for simplicity, we just assume that everything's going to be fine. So P&L gives you an overall picture of what the profit of the company is for a given period. The next component of a financial report is the balance sheet. As you probably inferred from its name, it shows balances. Balances of all accounts that you have in your financial ledgers. Here you see the balance sheet of our new business as of the end of the first year of its operations. Usually the balance sheet shows two dates, the beginning of the period and the end of the period. First you see assets. Usually they are grouped in the order of diminishing liquidity. The liquidity is the easiness with which you can convert an asset into money. The easiest one is cash, of course, because it is already money. And then here goes, for example, inventory, which you need to sell first before it can be turned into cash. Fixed assets, for example, it is harder to sell them. It takes a longer time, so they go lower in the balance sheet order. Also, there are liabilities, your debt. Short-term debt is just the debt you have to repay within the next 12 months. If it is longer than 12 months, then it is a long-term debt. Short-term debt first, then the long-term debt, and also your own money, the company's own money or equity. In our case, it is equity which was contributed by you in the beginning, and then there is this profit for the year of 30,000 that we've seen in the income statement. The balance sheet contains so-called retained profit. Retained profit is profit less any dividends that have been paid to the shareholders. Basically, the balance sheet shows what the company has, shows all its assets, shows its debts, and the most interesting is usually the dynamics, what changed for the year. The third component of a financial report is the statement of cash flows, or just cash flow statement. As you can infer again from its name, it shows cash movements throughout the period. In our case, it's been the first year of our company's operations. As you can see, the cash flow statement has several parts. The first part is the operational cash flows. It shows all the payments that are part of the basic life of a company. Receipts from customers, payments to suppliers, payments to employees, and so on. The operational cash flow section shows if the company can generate money from its operations or it needs to find money somewhere. As you can see from our cash flow statement, our company in the first year of its operations had a negative cash flow from operations, negative $10,000. So it has to find money somewhere. The other parts of the cash flow statement show where the company got the money from if the cash flow from operations was negative, or where it spent the money if the cash flow from operations was positive. So in our case, you see that the company's cash flow from operations was negative $10,000, so the company had to ask its shareholders to invest some money in order to cover the deficit. I would like to draw your attention to one distinction. You should not mix up income statement profit, sort of the profit on paper, and cash flows. In real life, many entrepreneurs, they do not understand the difference. They look at their business based on its cash. If it's cash positive, if it generates cash, everything's fine. If it's cash negative, maybe it's time to close the business. For example, in our company, during its first year of operation, there is a negative cash flow. Does this mean that we have to close the business? Not necessarily. We see if we take a closer look at our profits, the company is profitable. It made about $30,000 of profit. We just didn't receive it yet. And we will receive it probably in year 2. We'll see that. In real life, looking at cash flows only, especially for young entrepreneurs, can be a very dangerous thing. Suppose you have a company where you have received a large cash advance from your customer. If you are an inexperienced entrepreneur, you can say to yourself, okay, finally I made some profit, I made some money, look at my bank account, I still have a lot of money there, let me spend some. And you start spending. But you have not earned that money yet. You didn't make any profit yet because you still have a lot of obligations to pay for. Suppose you have a construction project and you get an advance. But later you will have to pay for materials, you will have to pay your employees, you will have to build something that you were supposed to build. And if you spend too much money from your account, then it can happen that you can go bankrupt because you won't have money to pay your suppliers or employees. That's why you always have to calculate your profits, and also you have to properly take care of cash. In the end, I would like to show you a shortcut of how you can easily make financial statements. If you have a ledger with all operations written down to it, just as the one that we have here, making financial statements is a very straightforward and easy task. You want to get a balance sheet? No problem, you just take all the balances of all your accounts at a certain date, you group them together by type, and that's it. You've got your balance sheet. You want to get your income statement? No problem. You take your profit account and take all operations from this account, group them by type, you get your income statement. You want to get your statement of cash flows? Again, it's very easy. You take the cash account, You take all operations in this account, you group them together, sort them, shuffle them a little bit to a nicer view, and you get your statement of cash flows. It is really easy, no problem at all.
So finally, we have made our first financial statements. You've learned how to do so. In the next lecture, we will continue to live with our company through its second year of operation, and you will see how financial statements are interconnected. You will also have a better understanding of how everything works in financial accounting.